Hi guys, this is Terry with Futures IO. It is my honor to welcome back John Hoagland for today's webinar, From the Pits to the Screens. If you have questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, you can do us a favor and please like, share, and comment. And also subscribe to our channel. It really helps us a lot. Don't forget that you can now follow us on Facebook and Twitter at FuturesIO. And I'd also like to direct your attention to the current webinar schedule. You can find the schedule on our homepage at www.futures.io. And without further delay, I'll hand it over to John.
All right, thank you, Terry. I'm not sure if you guys can see the screen now. I think you can.
You should get a pop-up. There we go. Looks good.
Okay. All right, good. My name is John Hoagland. I'm also here with my partner, Mick Ieronimo. We are both members of the funding department here at TopstepTrader.
Hey, everybody. Thanks for joining us. Excited to be here.
Yeah, me too. And, you know, we enjoy doing these, and we certainly thank all of you for attending and for trusting us with your time. Many people that are in the futures industry right now aren't really that familiar with the way things used to be in the pit and some of the major differences that people going from the pit to the screens are dealing with. So we're going to introduce ourselves a little bit here first. We've all read this. We've all seen this. It was streaming before the webinar here, so we'll go past that. Again, my name is John Hoagland. I've got 33 years at least in the futures industry. Traded on the floor for 20 years, and I migrated to screen trading in about 2009 when I think most of the transition occurred. Pretty much is it 2009, 2010. A lot of people were leaving the floor and learning to trade on screen. And really I've tried to and succeeded with many, but we've helped literally thousands of traders here at TopstepTrader over my tenure here of 5.5 years. I'll pass you on to Mick now.
Hi, guys. Mick Ieronimo here. Thanks for having me. I've got kind of a wide range of a background in the futures industry. I've been fortunate enough to work with multiple types of market participants. My background started clerking down on the grain floor in the wheat and corn pit for a broker as well as a couple local traders. I started trading for myself in 2008, did that for several years, and then I moved on to a proprietary trading firm. We specialized in making markets in the grains, mainly wheat, corn, soybeans, soybean meal, and soybean oil. Left that after about a year or so to work with Linda Raschke, where I did execution for her Granite Fund. We were mainly using technical analysis for our speculation, and I've been with TopstepTrader since early in 2015.
And we're very glad to have you, Mick. You're an excellent addition and a very smart trader and smart educator, so we're glad you're here.
Thanks. That means a lot coming from you, John. I appreciate it.
All right. So we're going to take a look at the trading pit and some of the good things that there were about the trading pit. Now, I traded in grains at the Mid-Am for a couple of years. I traded several of the pits at the CME and spent most of my tenure here in the S&P pit, this is an overhead picture that you have here on the screen. I'm in that picture somewhere, but it would be very difficult for me to pick myself out in as small as that is. But this was one of the advantages of trading in the pit. You could see all the participants. Every order was coming into the pit. You could see your competitors. It was very easy if you were paying attention, maybe keeping track on a trading card. You could watch what the major players were doing.
And their emotions, too.
And their emotions, absolutely. Understanding the inventory of traders in longer stronger money would certainly give you an advantage. It would give you an opportunity for trades when the shorter time frame traders became too long or too short. Now, when I say too long or too short, if you have all the major banks buying S&Ps, you could stand in the pit and watch J.P. Morgan buying. You could watch Goldman buying. You could watch Merrill Lynch buying. You could watch Shearson buying. They're not buying it from each other. They're buying it from the shorter time frame speculators, the local traders in the pit. When they basically cornered the local traders in the pit, that's what I mean by short time inventory getting too long or too short. When you knew that the pit was too long or too short, it gave you the opportunity to take the opposite, to understand what your competitors were doing, seeing the emotion in their eyes, and being able to respond in the correct manner to profit from yourself. You always wanted to know what your competitors, when they were cornered, you wanted to go the other way. It also gave you the opportunity when you sensed that the longer time frame, bigger money was moving to one side or another. It gave you an opportunity not only to stay out of their way, it gave you an opportunity to side with them and to carry those trades for longer profits. Now, before computers, before social media, and the many wire services that became accessible to retail traders, the information got to the floor first. By the time the rest of the public found out about anything, it was probably too late to get the best trade location. And it seems more and more a lot of that information is coming through social media, through Twitter feeds. When something comes out, it spreads like wildfire, and it seems like everybody gets the news at the same time now. On the floor, we seemed to get the information first. Of course, this is before computers, before social media. In the trading pit, most local traders, the people that were in the pit basically as speculators, purely trying to make money from price movement, were truly scalpers. Okay, this was before HFTs and algos. Or they were scalping a position for longer time periods. When I talk about a pit trader being a true scalper, they were basically on the bid and the offer. If they got hit on the bid, they tried to sell the offer. If they couldn't sell the offer, they'd try and scratch the bid that they just bought. And the same was true on the other side. If they were both on the bid and the offer, somebody hit their offer, they're now short, they're trying to work the bid so that they can take that little bit of profit. If they're unable to do that, they're going to try and scratch that trade or buy that offer before it evaporates. People were able to do this several hundred times a day. There were even times when I got hit on both sides, the bid and the offer, at the same time. It was, sometimes it would be that easy. Although I don't want to let anybody believe that pit trading was ever easy. This is just some of the good points about being in the trading pit, was the fact that all the participation was visible to you, and it gave you, I think, a lot more solid information with which to make your trading choices with.
So I'm going to talk about some of the bad things about pit trading. First and foremost, the barrier to entry was very, very high. In order to get down on the floor, get a jacket, get your badge, start trading, you either had to be leasing a seat or own a seat. This could run anywhere from upwards of the hundreds of dollars up to a couple $1,000s, few $1,000s a month, memberships in the six-figure range. Not only did you have that overhead cost on a monthly basis, but you had to have a relatively large bankroll in your account for margin. To top that off, you also had to have some insurance policy on your account And in many cases, that was, like it mentions in there, at least $50,000 worth of T-bills to protect the clearing firm. You know, the pricing for seats were an open market. There were bids and offers. At times the spreads were narrow for what people were looking to lease or pay seats for, and at times they're wide. You can actually see this on the CME's website right now. They do have the market on there. Last I checked, the bid offers were pretty wide, at least for the NYMEX seats.
Now, Mick, that went as a market, so you could purchase a seat, and there were times when an IOM seat at the Merc was maybe 50,000, and there were times when the full seats at the exchanges were well over $1 million, and it was really kind of directly related to the amount of opportunity available at the time. That there's always ebbs and flows with opportunity in trading, and it was true in the trading floor as well. So there were periods when if you wanted to trade S&Ps, you could have paid $500 a month for your lease, and I saw it as high as $3,500 a month. It was really directly related to the opportunities on the floor.
That's a great point. I'm glad you mentioned that, John. So as far as people, breaching this barrier to entry and getting into the market, how do you get into this business? In most cases, you had an older relative, an uncle, a dad maybe, that was in the industry, had worked his or her way up from a runner to a clerk to filling paper for a firm, and then maybe going off on their own if they're successful. So a lot of times people would back you, give you a little foot in the door, give you a small account to trade. Another way, family money, a rich uncle or something like that. As we mentioned, it was very, very expensive to get into this business. So aside of working your way up from the runner position into a trading position, this might be a quicker route. In many cases, this is an area where you would see a lot of people that didn't have success. They weren't paying their dues. They came in, saw dollar signs everywhere floating around, and they were thinking about making it big without having a great background on how difficult the business was and the way these markets worked. So others, other people, you might have clerked for a large local trader, or maybe not even a large local trader, but you built some allegiance with them and proved you're trustworthy and dependable, and someone might give you a shot. I know a couple handfuls of guys that were fortunate enough to work for good people that were successful, and they wanted to help out someone who had helped them out for years. And really, these were, I know it's just 3 ways to get into the business, but this is kind of how it worked out. I mean, it was difficult. Not everybody could get into this business.
And as difficult as it was to get into the business, there was no guarantee of you ever making a dollar. And you're right. I think a lot of people that got it, that had the opportunity handed to them from family money or anything like that, they were not prepared for what they were getting into, and I saw a lot of them come and go relatively quickly. Of course, there's always the outliers of ones that were successful, but we don't know what they had gone through before that. I think the people that had the best opportunity were the ones that worked on the floor, worked their way up, worked for a firm, worked for a local, took the time and really learned about the business and learned about trading before actually getting the opportunity. I think even today, many people don't understand that there is so much to know. They don't even know what they don't know.
And with that, to just add to that, these markets, as we all know, they're ever evolving. One thing that works for a couple months, well, that changes, and you have to relearn and readapt. So it was a never-ending learning experience. So the longer you were around, the more aware you were of how these environments could change. And we're talking about trading pits right now, but this obviously applies to screen trading as well.
and now the ugly. Now, one of the ugly parts of the trading pit was there was no automated risk management. Your clearing firm probably wouldn't know what you were doing until the end of the day when all of the cards were turned in and everything was key punched. There was a time back in the early 80s when traders were not required to even turn in their cards periodically throughout the day. They could just trade away, keep those cards in their pocket, no matter if they were up $1 million or down $1 million, turn those cards up at the end of the day. The clearing firms really had little to no knowledge of some of the risk that some of their traders were actually taking. Of course, as requirements, as the CFTC, as rules changed, we had to turn in your cards periodically throughout the day. As a matter of fact, I think near the end of the floor, you had to have them turned in every 15 minutes. They had to be time-stamped, turned in, and key punched every 15 minutes, just for this risk management and also for the audit trail.
And to add something to this, there were times where I'd seen risk managers come down from the offices upstairs and put their hands on a couple people's shoulders and tell them it's time to exit and walk away.
Yeah, and I've seen some of them on their knees going, "No, don't take me out! Don't take me out!" So it's a very emotional thing. Another ugly part of the trading pit was the fact that there were out trades. When you take a look at a trade, it takes two parties. If one party doesn't see the other trade, doesn't see the other person trade with them, or for some reason doesn't know the trade, well, the other party could still be at risk on that trade. Okay, they're not going to have the closing end of one of their trades, and they may not be aware of it for some time. Out trade risk was sometimes absolutely huge. Sometimes even overnight, you would think you had made a trade with somebody across the pit. They traded with the person next to you. You never connected that, and that left you hanging out in the breeze. We don't have that problem anymore in electronic trading, and to me, that was one of the ugly parts of the pit. I used to just like lay at night and think, "Oh God, did I check that 100 lot?
Mm-hmm.
Did I get that trade? Where's the market going to be in the morning?" Because we didn't have the opportunity to get out overnight. Where's the market going to be in the morning if I'm out this 100 lot? It was excruciating at times, sitting there thinking, "Oh, did I make that trade, or did that guy trade with me?" I kind of like the electronic version because I know everything I do is done.
Yeah, and to touch on the scariness of these out trades too, I mean, this was a business where most of the people down on the floor had a great deal of integrity and accountability, but when there is money flowing around, there are certain walks of life that might take advantage of opportunities to maybe steal a little bit. There were some crooks, but this was a very, very small percentage of the business down on the floor.
And all of the lack of risk management, the out trades, all of the risk that was being taken on the floor was part of the reason the barrier was so high. That everybody required large cash funds that had to remain in traders' accounts in order for them to continue to be able to trade, and this was really one of the big barriers: the seats and the fact that you had to have so much money up. Now we're going to take a look at the beginning of electronic trading, and Mick, I'll let you take this one.
Okay, so a lot of good things about electronic trading. We're talking about pit trading, screen trading, and the transition. It's no secret that the transition from the pit to electronic trading had a lot of people upset, changed the way people made their livelihoods, but there are a lot of good things about electronic trading. First bullet point we have on there is management of risk. Right now, you don't have to have large amounts of cash to participate. Part of the reason for that is everything can be monitored by the brokerage firm, the clearing firm online. They have lists of their traders, positions, margin levels, kind of stuff that John and I look at on a daily basis. As far as opening up an account, you don't have to lease a membership. You don't have to have the huge amount of T-bills in there. You don't have to have all this margin money. There are brokerage firms out there that will let people open up accounts for, you can fund an account with $2,500. Now, many brokerage firms will do this. It's usually not in people's best interest because we know the kind of leverage all these futures markets can have, and you could on any given day make or lose $2,500 trading a one lot. So this really, without having to have the memberships, lowered the barriers to entry. Lots more of market participants are able to join. You don't have to have the cash. You don't have to have that rich uncle. You could save up a little cash, fund your own account. That's what I did. I saved up money throughout high school and college, and towards the end of college, I was able to open up my own futures trading account. Obviously, I have to talk about TopstepTrader too. Barrier to entry, we fund traders. You can come in, pay for an evaluation, and you've got a chance at getting a fully backed funded account. So this really expanded how many people could get into the business. It's added quite a bit of volume too. It's been very, very nice.
And no more out trades.
No more out trades, that's true. We just have to worry about internet connections and platforms, that kind of things, which just like the out trades in the pits, those were a cost of doing business. And you do run a risk. This is a risky business. You do run a risk at maybe losing a connection here and there. It's happened to me. I've had a few scares like that. I think everybody who's been around the industry for a while has experienced that in one way, shape, or form. Nowadays, with the electronic contracts on Globex, they've changed some of the tick sizes in these contracts. Sometimes they change them to be smaller, then they change them back. They add half ticks, they take away half ticks. This is kind of always changing, but one thing that this has helped with is allowed users, producers, and even speculators, to fine-tune the hedges on their positions. They could get more accurately close to their crops. They could hedge the crop a little bit closer without being overhedged or underhedged. John, you want to talk about the fungibility of the contracts?
Sure. Initially, many of the contracts were originally smaller, like the E-mini S&P is 1/5 the size of the big one. But when it first opened up, they weren't fungible. If you got in the minis, you had to get out of the minis. If you got in the bigs, you had to get out of the bigs. Eventually, they made those contracts fungible, and it created arbitrage opportunities between the big open outcry and the electronic contracts. Okay, I know a bunch of people who were they were in the right place at the right time, and they were able to take advantage of that arbitrage opportunity between the open outcry and the electronic contracts. What that means is when the open outcry became out of line with the electronic contract, maybe the E-minis were trading 21 even, and I was able to buy 2070s in the pit. I could turn around and sell those 21 evens in the E-mini and instantaneously make that profit. Now, that's kind of what arbitrage does. Arbitrage does serve a purpose in futures trading. It keeps similar contracts relatively close together, but there's always that little difference, and making those contracts fungible created that new arbitrage opportunity, which many people were able to take advantage of. We can't really do that anymore on electronic, but what it did is it really helped increase the volume and liquidity of the electronic contracts. The fact that the arbitrage was going on brought in a lot of volume and liquidity, in essence. because if somebody bought 100 S&Ps in the bags, they'd have to sell 500 S&Ps in the minis in order to equalize or to get out of that position. So when they became fungible, it really boosted the liquidity and volume in the electronic contracts.
John, can you go back?
Of course.
Just one of the great things that we neglected to mention here about electronic trading is in the past, in the trading pits, okay, you're a wheat trader. I spent a lot of time in the wheat pit. Well, you're standing in the wheat pit, watching the wheat market, looking at what's going on, predicting price movements, and you were pretty much stuck in that pit. You could definitely run from the wheat pit to the corn pit to the soybean pit if you wanted to make some of those trades. But as you saw from the first slide, that picture that John mentioned, you might be able to point them out in there. You had a lot of people to run through if you needed to get over there and either put a trade on at a certain location or exit a trade at a certain location. And another thing about that, from bouncing around pit to pit, a lot of guys did not move from pit to pit. They would stay predominantly in one area. Well, what happens when the wheat market's completely dead in the wintertime? You're stuck there in a slow market. There's less volatility, less volume, and with less volatility and volume, there's less opportunity. Nowadays, on the computer screen, you've got your quote board with 20 different futures products on it. You don't have to sit there and watch the wheat go quarter bid at a half for an hour. You can scan the markets, see where there's price movement, see where there's opportunity, watch the volume, see where the action and see where the people are going, and you don't have to sit around and watch one market. Not everybody can do this, but certain people have strategies where they can apply one strategy over the course of maybe all the currencies, or maybe all the equity indices, or over all the grains. Granted, they have different fundamentals, but these are approaches that you can mix and match between certain exchanges and certain product asset classes. Another thing, in front of the computer, I don't know about everybody, but I know there's a lot of shorter time frame traders out there. Fundamentals don't play out in the shorter time frame, so not many people are trading fundamentals off of if you're in and out scalping during the day. You can have your charts, your technical indicators. You have thousands of indicators that are out there. There's so much stuff. A lot of it's garbage. Some of it's very good. I find the simple things to be very good, but I can have 10 charts on one of my monitors to see what's going on. So just wanted to mention that too. I think that's a big thing. That's something, when I started trading, I never traded for myself on the floor. I started trading on the electronic markets. I did always want to start trading in the pit. It was a very glorified occupation. There was a lot of action, chaos, that kind of thing. But I felt that I was at a much better advantage having everything at my fingertips.
Thank you for that, Mick. The bad, early electronic markets were thin. There was not a lot of market participation. Exchanges actually started providing hardware to entice traders to make markets. If you were a local on the floor, the exchange was coming to you and saying, please make markets while you're at home. We'll give you the hardware. Just start making markets when you're at home. Another part of the early electronic trading was really educating the trading community on how to trade electronically was slow and cumbersome. Most people resisted even trying to find out, especially early on. The CME had a Globex Center where you could sit down on a simulator, and I don't remember seeing a lot of people in there.
And not also these traders that were in the pit that had made a living and a career out of doing this pit trading also they were a little hesitant to seal their own fate too by making the transition to the computer screen, because they knew it was going to be different.
Well, I mean, I was a clerk in the S&P pit during the '87 crash, and after the '87 crash, we were hearing, we've got 2 years left. It's going to be electronic within 2 years. So that would have been 1989, and really we got another maybe 30 out of it. you know, and I think in large part it was the resistance of the floor community to make that change, and even the off the floor customers, you know, for a long time still preferred the pit. I mean, if you think about it, the risk transfer of one big S&P or 5 small S&Ps, 5 E-minis, it's more expensive to trade the E-mini for them. So I think that was part of one of the reasons that it slowed, and that's probably the reason that the S&P pit still exists. It's the last pit.
One thing about what John was just mentioning about the exchanges giving hardware, enticing traders to make markets, and the electronic transition was slow and cumbersome. I remember in the grains when people started implementing the computer tablets, guys would go down there, guys and girls, trade open outcry, but everybody had a computer tablet slung over their shoulder with a little stylus to watch the electronic markets, and there was a certain time, it didn't last very long, but people could arbitrage the computer versus the pit. You would see 3 bid on the screen, and it was offered, it was 2 sellers in the pit. So what do you do on the screen? You sell the 3s and then buy the 2s, and people could do this multiple times throughout the day, and sometimes on, maybe it was a 1 lot, sometimes you could do it on a 20 lot or more, and that really added up. It was easy pickings for a little while.
Yeah, that arbitrage worked well for a lot of traders for a long time. And the ugly. If you ask me, the HFTs and the algos could be part of the ugly side. They were kind of predatory, found ways, and they continue to find ways to edge out discretionary traders. They are considered market makers that brought liquidity to the marketplace, which you can't deny that. They do provide a big quantity of liquidity to the marketplace, but they also, you know, some of them have even been proven to be spoofing and using other practices that eventually did become against exchange rules, but it is hard to police. The playing field is more even now, I think, than it ever has been, but I don't think it's quite perfectly even just yet. When we take a look at electronic trading today, making the similar products fungible in the US really did, I think, exacerbate the transition from pit to screen. The available liquidity on screen was now finally to the point where I think many people became much more comfortable in trading on screen. We've already mentioned the profitable arbitrage opportunities the floor traders had that added to that liquidity. Technology has improved, and trading platform stability has improved. The automated risk management has lowered the barrier of entry, and I think that's probably one of the biggest reasons so many people, so many retail traders have become so interested in it. And I implore you, if you are a new trader, make sure you educate yourself, make sure you take your time before risking any of your own money. The lowered barrier has, like I said, has created a vast pool of short-time speculators. It is the perception of a level playing field, even though, you know, in some respects it isn't completely. There's almost 24-hour availability, 5 days per week. I think if you're trading Forex, you can pretty much trade all the time. Ease of monitoring and trading several markets using a couple of simple strategies across multiple markets. Mick already kind of touched on that. That can be a good or a bad thing, and as well as that multitude of charts and studies at your fingertips. I think many people tend to complicate their trading plans too much, and I like the keep it simple, keep it super simple method of trading. The bad.
So like John had just mentioned, what I was saying about having all this information at your fingertips, it could be a good thing having all these technical indicators to the studies on their charts, but this can also lead people to think too much and try and find too much information in the wrong places. So it could be detrimental as well. Another thing about trading on the screen, a lot of people do it from a home office, from their bedrooms. a lot of people are out there alone. There used to be a ton of camaraderie on the trading floor. Things slow down. You crack jokes, go out to lunch with people, throw jabs at people. It was a lot of fun. It was a very tight-knit community, and most people were happy to be there. Now, I traded from my the desk in my bedroom for a couple years, and I was bored as could be. I eventually sought out a couple other people to share a little rental space in an office, and that made a world of difference. Another thing that's bad, we all know sitting around is not any good. Well, unless you're standing in front of a computer screen, you're sitting down slouching, probably pretty nervous, hunched over, and that's the exact opposite of jumping up and down and screaming all day for 4, 5, 6 hours or more, depending on which pit you were in. I was kind of lucky in the grains. We had the markets open for 3 hours and 45 minutes during the day.
And then down to series.
Now they're close to 23-hour markets. But a bad thing, John talked about being able to see the Goldman, the big institutions buying and selling. You knew who those brokers were. You knew what they were trying to do. If they were standing up with their hands, their palms in all day long, you know what the big money was doing. Now, competitors, you don't know who's doing what on these price ladders and domes. You have iceberg orders. It looks like there's 5 on the bid. Someone comes in and sells 100. Well, 100 gets taken out, but it still shows 5. 100 again, 100 again, 100 again, and you don't know if there's 5 contracts there or actually 2,000 contracts on the bid or the offer. These markets are pretty transparent, but when it comes to that kind of stuff, I don't believe that that's great transparency.
Well, yeah, you can't see them. You have to determine what you're seeing in the market, and we're going to show you something that I've found to be useful. Some of the traders at TopstepTrader have found to be useful, and we're going to get to that in a couple of minutes. But yeah.
So yeah, these iceberg orders, and like John said, we're going to show a price ladder or a dome coming up in one of the next couple slides. But to go along with the iceberg orders, the way you can enter and cancel orders and the algorithms for pulling working orders are so fast, you can't see that kind of stuff, where it's okay to do that, to enter and cancel orders to a certain extent. There are people that get in trouble for that, doing it on a very large scale. But if I had my hands up trying to buy and John said sold, and I put my hands down and said no, I would have a very intimidating, angry man coming at me. So you wouldn't get away with it. People eventually wouldn't trade with you if that's what you were known for doing. Now there's nothing like that on the computer screen. So yeah, you do not really know who you're up against out there anymore.
No, you don't, and not to mention, you never know when you're going to have an internet or Wi-Fi issues. We recommend definitely not trading on Wi-Fi. If you must, be aware that you may end up with issues from that. So, true scalping is now done by automated strategies. There are those that might fight me about that. There are tools that I believe can help very short time frames scalpers, but I believe that the majority of the locals in the pit, the way they used to trade, is now taken over by the algo and HFT traders. They are way too fast for the discretionary traders. The one thing that I believe that we humans have is the ability to adapt, and we have that ability to adapt almost instantly. Many of these programs are predatory in nature. They do tend to play on emotions and weaknesses of those traders who try and compete with them. And I think we're going to take a look at now what it would be like to try and scalp a single market against a faster competitor the way we would have maybe in the pit. Now, I know this may be a little difficult to see. I think it looks pretty good on my screen there if you want to take a look at it.
Sure, definitely. I'd love to talk a little bit about scalping and my thoughts on it. I think scalping is a a dead sport. John mentioned trading in the pit. He could be working the bid and the offer, maybe get hit at both times. There were hundreds of other people in the pit working. They were 2 bid at 3. There's large size. These markets, they had a lot of traders to trade through, and the markets didn't swing around. We have the crude oil dome from the other day up here. You can see the market's down $1.76. The high was 40 on the day at this point was 46.41. The low was 44.51. It's a 190 tick difference. Now, to think that you can trade on the shorter time frame in a market like this, where you could buy it at the bid and sell it at the offer, is asinine. These bids and offers, you can see 37 on the bid, 15 on the offer. I know a lot of you guys out there are crude oil traders, and you know how volatile this market is and whippy, and I know that's one of the things that is enticing to traders. You know, the P&L swings. You know that in a very short time the market could go in your favor and you could be up big money. Well, to try and scalp in a market like crude oil, where you are looking to make maybe 1 or 2 ticks, is very unreasonable, because you're going to have backwards reward to risk ratio. In a market like this, which most of you are familiar with, it's one of the larger contracts out there, very popular. If you're trying to make 1 tick on a trade, what happens when you're taking a profit for 1 tick when it works out, but when it doesn't work out and the market slides 10, 20 ticks against you? You are risking 10, 20 ticks to make 1 or 2 ticks, and it's just completely backwards. I've seen a lot of traders get cut to smithereens doing this in certain markets. I myself early on was someone who learned very painfully that this just is impossible. I tell everybody I work with this: the higher time frame is in complete control. Every trader out there is going to be better off if they bring a top-down approach to the markets. What is the weekly structure? What is the daily structure? What are the trends? What is the market environment? Is it trending? Is it channeling? Are you going to get cut up trying to sell lows and buy highs? Are you in the direction of the trend? And then you can look at lower time frame charts for low-risk entries. But if you're just staring at a 5-minute chart all day long, you're going to have no idea what the higher time frame is doing, and you might not even know the trend. So a 5-minute bull flag that looks textbook looks great. If you look at an hourly chart, it could look like a hourly bear flag, and which one of those is going to play out? In most cases, it's going to be the higher time frame chart. So I really want to tell everybody to be cautious trying to scalp for little ticks. Know your time frame. If you are scalping, if you're trying to scalp looking at a shorter time frame chart, you have to adjust your risk with all of that. And if you're doing that, you really need to be low risk. So to compare this crude oil dome, I'm going to have John, can you flip to the next screen? Okay, this is a little bit different. Right here we're looking at the Sept corn spread. It was the front month corn spread. The price in the middle of the ladder, minus 13.4. That means that the September contract is trading 13.5 cents below the December contract. Now you can see the bids and offers on this screen. People in the spreads, they're trying to profit off of the price difference between these 2 contract months. Now, I had mentioned earlier when I introduced myself, I was with a small prop trading group. We were market makers in the grains. All we did was trade the spreads, and we would work large size on the bids and offers. You can see this is the range for the day is 2 cents in here, so 8 ticks. I mean, this is the daily range. Volume's not huge like it was in the crude oil, but 8 ticks. These spreads usually move a little bit slower, so it's a safer environment to try and buy and sell to make 1 tick profit. What we would do is we would sometimes work orders on the bid and on the offer, usually larger size, because we're not going to capture a 20 tick, a 60 tick move in the crude oil. We're trying to make 1 tick hundreds, thousands of times a day. And if we bought the 13 halves on the bid where there's 236 bid there, we would try and sell them at 13 quarters. And if it looked like the bid was wearing down on the on the blue side, the buy side, and we had owned some, we would immediately just sell into that bid and scratch the trade. We were trying to make one tick or scratch the trade. You can do that kind of stuff in the spreads. You cannot do that kind of stuff in the crude oil markets. So I just want, I think spreading's a great strategy. This high-risk industry, you know, spreading off your risk is not a bad thing. It's not for everybody. We talk about technicals. The spreading is kind of a fundamental game, really. You can use technical analysis to trade them, but I mean, these spreads trade way out, and users, producers are usually utilizing the spread markets to mitigate their risk. So I really was excited to throw this corn spread up here to kind of show you some of the differences between trying to scalp in the crude oil and trying to scalp in the spreads, deep spreads.
This is much more like the pit used to be. If you bought the bid, if you couldn't sell the offer, you hit the bid. Mm-hmm. This is much more like the way the pit used to be, and it's a thicker market, doesn't move as quickly, but you're going to have to trade bigger, but it is possible.
Yeah, I had a lot of fun trading the spreads.
All right, thanks, Mick. Now, the one I wanted to show you is I don't know if anybody calls it this. I don't know if anybody even really looks at it, but it's a tool that I've been looking at for the last 6 months, and it has been proven very, very helpful in assessing the longer, bigger time frame presence in the market. Okay, your ability to see the market state and who is currently present in the marketplace can give you an edge over your competitors. This is a quote from Jim Dalton, who I think is a genius, and who I learned a lot from his books. Keep in mind, 90% of your competitors are going to lose. Understand them and avoid their traps and imbalances they consistently fall into. Okay, and I'm going to show you, using market profile and delta, how I was able to sniff out longer time frame presence and at least stay out of their way. I actually was able to take a good advantage of these trades on these particular days because of this delta divergence. I've been showing some folks here at TopstepTrader it, and I intend to show them more because I think it's very useful. Is it useful day to day? Not necessarily. Only when you really seem to be catching the longer time frame sneaking into the market. Now, here's why. I hope everybody can see this. Is there a pointer I can use?
Let's see.
Or is it just you can see my
I think
my
you should be able to draw.
cursor, right? All I want is to be able to see the cursor. You can see that, correct?
Yes, we see the cursor.
Okay. This is August 10th of this year in crude oil. This is 8 a.m. to 2:30 p.m. market profiles. Okay. On this particular day, you can see this is the opening here, the opening balance, then the market moves lower. If you don't know profile or the T4 profile, the red TPOs are early in the day, then they go yellow, then green, then blue. Okay, I'm trying to give you the direction of the market this particular day, and this D right here is the delta. Delta is minus 2170. Now, what delta is on this particular day from 8 a.m. to 2:30 p.m., 2,170 more contracts traded on the bid than the offer. Now, think about that. It would indicate that the sellers are more aggressive, correct? They're the ones hitting the bids. They're the ones that are actually taking action, not just waiting for offers to get filled. They're taking action, so they're more aggressive on this particular day. This makes sense to me, okay, that the delta on a day moving in a lower direction would have negative delta. Okay? The following day, on August 11th, this is the opening range. This blue line here is the first hour of trade. Obviously, this market is moving higher. Wouldn't it make sense then that delta would be positive on a day like this? But it isn't. It's negative, and it's negative 5,365. What the longer time frame does is they place bids when they're getting long. They're placing bids, and they leave those bids there to soak up everything the short time frame can give them. When the short time frame ceases to sell to them, they move those bids up. The shorter time frame says, okay, well, we like them down there, we're going to sell them here too. This was an entire day that started off very aggressive, but most of the delta that occurred on the negative side was in this session, this part of the profile right here. Bids, 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 short time frame traders selling into those bids, in decreasing the delta to negative 5,300. This to me seems wrong. There's something that I'm missing here if I'm not recognizing, okay, there's somebody in here that is placing bids and just letting people bang into those bids. And if you ask me, it's probably going to be the longer time frame. So we can actually see the market open the following day. This would be August 12th, and that's my next screen here. Okay, this is August 12th. It's a much smaller range. The opening range remains the low of the day, and the direction of this day resolves higher again. Maybe not as aggressive on the buying side is the longer time frame, but they're still present. The market's moving higher, and we have negative delta. Somebody is placing bids until the short time frame will not sell them to them anymore, and then they move those bids up. Okay? Now we continue to see long time frame activity in this market in the same way. The opening range is the low of the day. The delta by the end of this particular day is minus 6,511. Okay? There are bids being placed, whether they're ICE orders that people are just keep hitting, or whether they're, I mean, you know that they're not placing 1,000-lot bids in the crude oil market that would scare the market away. They're doing it just enough to where the short time frame will continue to sell into their bids, and when the short time frame won't sell them to them anymore, they move the bids up. This is August 15th, August 16th. Okay? The day continues in an upward motion with negative delta. The long time frame buyer is still present in this market. The market opens here. They buy all they can here. The market moves higher. Okay? The following day, the 16th. Whoops. Let me go back here. The following day, the 16th, even more negative delta, negative 6,200, okay, in a day that appears to be relatively balanced. Here's the 16th, the 17th, we still have negative delta. Finally, we get our good pop to the upside. Okay, opening range, the market could rotates higher all day, and we still have more aggressive sellers than buyers. We still have more aggressive sellers than buyers. But who do you think the sellers are in these periods right here? Okay, we've had long time frame buyers cornering the short time frame shorts, the short time frame shorts finally capitulating and buying now from our long time frame buyers that have been buying on this particular day and this particular day. When you get this nice even bell curve, there's a change probably coming. Okay, this balanced day was telling me, okay, this move is it might be over, because We've had directional movement. We've had negative delta. We still have negative delta, but our long frame buyers aren't buying it anymore here. They're probably the ones that are letting the now losing money short time frame shorts out of the market. The very next day, we move lower, we move lower. Okay, so just reviewing, when you see days moving higher with negative delta, it should tell you that there's somebody in the market that is basically controlling it, other than short time frame traders. Okay, short time frame traders are basically going to trade delta to zero. I think much like yesterday was, I think, or the day before was in crude. I don't know. There was no delta, so that tells me that there really wasn't all that much buying or selling that aggressive in either direction. Okay, so that is delta divergence. If you have the ability to time frame your delta into the day time frame only, if you're using T4, if you're using another platform, see if you can do that. Make sure you can, you know, if you have delta, start paying attention to it, because it can tip the hat of the longer time frame, stronger money coming into the market. Okay, this is something I've been using for 6 months, and it's been working really well. I've got some other people interested in it, and it's working pretty well. I don't suggest using it every day or even starting to use it until you get a feel for it, but this is a tool that has been proving very nice opportunities for me, or at least keeping me out of the way. Okay. Again, when the market direction is opposite the delta, you might be looking at something. Again, trading is difficult. It can take years to become consistent and profitable. Any tool that you add to, you got to get to know. You have to create an intuition around. You know, if you are new at trading, if you've moved from pit to screen, if you've left the business, you're coming back for a while, TopstepTrader is a great option for you. It allows you to learn and develop your strategies in a safe environment, while also being considered for a funded account. Okay, you don't have to risk your own capital. You may be funded in as little as 20 trading days. And you also have the funding department to help you maintain your personal risk management. That's something that a lot of folks have found very useful in gaining some consistency and profitability. This is a hard thing. You can lose thousands, if not hundreds of thousands, if you're not careful. Take your time, learn, and come to us. We need good funded traders, don't we, Mick?
Absolutely. Always looking for good traders.
So start trading this with us. Okay, visit the website below for a special offer. We thank everybody for joining us today, and especially, you know, trusting us with your time. I hope that in anything that we present and anything that we offer, that there's something that you haven't noticed before, that you've learned something that you can add to your intuition, that you can use in some way.
This was a lot of fun, everybody. Thanks so much for having us. I just had a good time. Hope you got something out of this. I always love giving my 2 cents. I really think that, you know, this is an excellent business with huge opportunity, huge potential, and you know, it's a way to, you know, make it on your own. But you've got to be disciplined and willing to put in the effort. So I wish you all the best. Thanks so much, everybody, and hope to see you again soon. Talk to you again soon.
All right, do y'all have a time for a little Q&A?
Of course.
Sure.
Okay, let's see. Why does TopstepTrader not allow a trader to hold overnight positions?
TopstepTrader would allow a trader who has been proving his performance and building equity in his account that opportunity once they get to a certain level.
Right. Honestly, when the markets close at the end of the day and there's a certain amount of time where the markets are not open in between, you know, the night session or the old pit session open in the morning, just the risk is very great. We fund so many traders that we already take on a huge amount of risk, and for a trader to have a position on where it doesn't matter if the markets are closed, it doesn't matter where your stops are. You're not going to get out if the market gaps higher or lower. It all has to do with risk
and performance. If you performed and you to a level that you've built enough equity in your account that you're willing to take that risk, we would consider it.
Okay. There's a person asking about spreads with a funded trader program. They always thought you were only allowed to trade outrights in front months.
We are looking into adding spreads to our program. Currently, we do not offer spreads.
Okay. When OTF turns around, do they then hit the bid or do the reverse?
When the other time frame is present in the marketplace, they very rarely put up a panic look or a really strong drive. Their strong drives are going to look like consistently higher or lower days, day over day. Only in rare occasion do they just bail. Usually when you see a big drive in one direction, the other time frame is already leveraged. Now, they're not always right. Sometimes they do have to bail, but for the most part, they're not getting in and getting out when the market is emotional. When the market has expelled its emotion, that's when they're more likely to get in and out, because when the market's emotional, there's not enough liquidity, there's not enough volume for them to be able to move what they really need to move.
Okay. The person asks if they trade with TopStep, do they have to use your software or can they use their own, i.e. Sierra to execute and chart trades?
We offer Sierra as one of our trading platforms. We don't have our own trading platform. We offer close to a dozen of the popular trading platforms out there.
But if they were using something that they preferred to use for their analytics, they could just execute on one of those domes.
Okay. Let's see. A person is asking if you can post the link to the special offer in the chat so they can click it.
Oh. Oh, hang on a second. I'm going to have to type it in. All right, let's hope this is right. I'm not the best typist, so hopefully that works. Let me know if that works for you.
Okay. Let's see. Is there a place where they can find the same oil chart that you were looking at in the presentation? They'd like to see it in more detail.
Yes, yeah. That was the price ladder on the T4 platform.
Okay.
And that was the market profile for the CTS T4 platform also.
Okay. Can you explain the CME order matching algorithms?
order matching as far as fills go, how those markets are filled, how the bids and offers are filled, and who gets their fills first or last?
That would be my understanding, yeah.
Okay. It's different
Yes.
for certain markets. Many markets are first in, first out, so if you have priority in the queue, you are going to get filled before anybody else behind you, regardless of what size they are working. There are other markets that are, I know the grains, for example, this was an important part of our strategy when we were making markets in the grains. Grains are what we would call, I believe they were 60% time and then 40% pro rata. 60% time meaning first in the queue gets filled first. 40% pro rata meaning there was an algorithm where depending on the size of your bid or offer, let's say you're working 100 on the bid out of 200, so you're half of the bid, and someone comes in and, well, let's say you're 100 of 200 on the bid, and the other 100 that are on the bid are 20 different people working 5 lots. So you've got the biggest quantity size order in there. So someone comes in and sells 100, so obviously that 200 is going to get shaved down to 100 because 100 traded on the bid. Whoever's got that big order working is going to be able to take most of that, you know, sell order that hit the market, hit your bid. So it depends on the own markets. It's a trader's responsibility to understand all of the contract specifications of the markets that they're trading. You've got to do your homework on this kind of stuff.
Most markets are, you know, the queue is you're first in, you're first filled.
Okay. All right, let's see. Have you looked at adding Forex?
We have, and we are, and we will. As timeline, I don't have it.
Okay. Is the promo only for new people, or can they use it if they bought a combine some time ago?
That's for new.
Okay. Let's see. How do I get T4 market profile and jigsaw trading at the same time through the TST combine?
Well, if you're on T4, it's a good question because I know that, well, I have them. I have I think the market profile in the combine you have to pay an extra $10 for. And then I have the jigsaw dome, and I also have his price map and all that as well. So it's just a matter of purchasing it from Jigsaw and then having the T4 in your combine.
Okay.
As far as I'm concerned, I mean, I have them both, and
okay, I'm assuming they can email support and they can walk them through it.
Yeah, I think you actually might have to have NinjaTrader in order to run it. Because I'm thinking about it now. I mean, I have them all on my computer.
T4 offers market profile separately, but as Jigsaw trading is a separate software, so
correct.
You would have to really just look in to see if that.
Yeah, I think you have to have. I think you have to have NinjaTrader in order to run it.
We know it runs on NinjaTrader.
Yeah.
T4 is a different story.
Yeah.
Trading my own account with Ninja, would you allow a TopstepTrader account to be included with mine on a block trade setup?
No.
No, we do not. If you want to have your own personal account, good. We have many of our funded traders that do trade their own personal accounts. We do not commingle funds. Your account with us is going to be completely separate from your own personal account.
Okay. Okay, yes, and there is, later this month, the new Jigsaw will come out with a standalone program. So,
Good, good, right, okay.
Does a person have to be a U.S. citizen to trade with TopstepTrader?
No.
Absolutely not.
No, we have, I think we've got
Close to 150 countries.
I mean, yeah, we've had
over the course
just
of
about
years.
every country in the combine, and we've funded many, many people from many other countries. No, you do not have to be a U.S. citizen.
Okay. Okay, I'm going to call this the last question. On delta divergence, can you give a little more detail on how larger time frame traders could, say, lift the bid without taking the offer?
What that is saying is the bigger money, the other time frame or longer time frame traders, if they are working bids and the short time frame traders keep hitting those bids, they're going to accumulate negative delta. Okay, so when the other time frame is buying at a particular level and the short time frame traders won't sell it to them there anymore, they don't start lifting offers, they just move their bid up. Now they may pick off a couple of offers in doing that, but then everything that once their bids are in there, when the short time frame traders keep hitting that bid, they're going to keep creating more and more negative delta. So when they move those bids up, they may actually be behind the market. They may put those bids in just below where the current market is and then just keep throwing bids in there as they keep getting hit, much like an iceberg type situation. And as soon as the short time frame traders are done selling it to them there, then they'll move that bid up, and the market will probably move up at that point. They'll move those bids up. They'll probably put it just below where the market currently is trading and start throwing in those iceberg orders again. So basically you end up with a delta that looks like it should be really negative and the market should be moving lower because you've got aggressive sellers in the market, when in fact you have somebody accumulating longs just by keeping those iceberg orders in, but just by moving those bids up and letting the short time frame traders sell into them.
Okay.
So that's one of the ways that I'm learning to sniff out the presence of the other longer time frames. I don't think we've seen the other time frame in the S&Ps in weeks, but just recently in crude oil we had that look. And I was so excited to present that because it was so clear to me. And if it's going to be clear to me, somebody else who's going to be looking at that might be able to benefit from it as well.
Okay. Looks good. Sounds good. Thank you guys for today's webinar. I definitely appreciate it. I always love hearing about the days of the pits and the fun times.
Well, we could go on and on about that.
Stories for days.
All right. If you have any other questions, please feel free to email support@TopstepTrader.com, and they can help take care of you, get you set up, answer any other technical questions.
And again, thank you all very much for joining us. Thank you for trusting us with your time. Think about some of the things we talked about, find something you can use from this, and we'll look forward to seeing you funded.
Yeah, this was a lot of fun. Thanks, everybody. Trade well.